So, hello and good morning to everyone. I'm Candace Liebner, Director of Title Services with Landtrust, Wisconsin. We also have Katie Osborne here. She's our Senior Account Rep also for Wisconsin. So thank you very much for attending. We hope you find this extremely informative. I know Attorney Patrick Harrigan has done quite a few of these with me and for our clients. We want to keep this really open as far as feel free to answer and ask questions whenever you have them. He does have a presentation, of course, that he's going to bring up on the screen, your handouts as well. Just to give you a little background too of Landtrust Title, in case you didn't know who we are. We actually started here in Wisconsin in October of 2020. We are from Landtrust, Illinois. Our parent company happens to be Baird Warner Title, and Baird Warner Title originated over 160 plus years ago. Still family run, still with the same family to this day. So we pride ourselves on helping out so many different families, whether it's with title or whether it's in real estate. It was a natural progression, of course, for us to move into Wisconsin. We have a lot of duly licensed agents that have their license between Illinois and Wisconsin. Why not be able to help them in both states? We also have branched out into Florida as well. So we're able to do title policies and closings also. Doesn't matter where those are at. We've completed quite a few in the Tampa area. Naples is where our main base is, but we've also gone into Miami Beach and Fort Lauderdale and those areas too. We just don't do the Keys. We're just not into those areas yet. Maybe we will in the future. So feel free to ask us questions about Landtrust as well, also today. But I want to take this time to introduce Attorney Patrick Harrigan with the exchange. Thanks, Patrick. Come on over.
Sure. I'm going to do my best to try to stay in one place for the most part without blocking the screen. Sometimes that's tough.
Okay, ready to share?
All right. All right, I'll just get started. So yeah, thanks, Candace. My name is Patrick Harrigan. I'm with Gain 1031 Exchange. So we are intermediary for 1031 exchanges. We facilitate exchanges, and of course I'll get into a little more detail with what that all means. I've been doing exchanges now about 17, 18 years. With this office since 2010, it's about 14 years. That's all we do. So we're not a title company. We don't do closings. We strictly facilitate the 1031 exchange as the intermediary. As Candace said, I am an attorney, but I don't do any law practice. Can't wear both hats. The IRS says if you're an intermediary, you cannot be attorney for that same customer. You can't be their real estate agent. You can't be their accountant. We have to be an independent third party to facilitate that exchange. So I don't wear both hats, even though that's my background. We're a member of the FEA, which is a national trade group of exchange companies, and we've actually got two offices. So we've got our Brookfield office here, and then we do have one in Bloomington also. All right, so yeah, we have a nice group here today, nice small group actually, so very conducive to answer questions. So please, I want to make sure that I'm providing the information you're looking for. So ask me questions. I'd be thrilled if we can just make this a discussion instead of a more formal presentation. I certainly prefer that. So let me know if you've got questions. I think we're going to. All right. Let's see if we're going to have some luck here. We're going to do it this way. All right, so what are we talking about? Most of the time, you'll hear 1031 exchanges, but you might hear starter exchange, you might hear tax-free exchange, you might hear deferred exchange, all the same, different names for the same thing. But what are we talking about? So 1031 comes from section 1031 of the tax code. And what it allows you to do is defer taxes when you're selling some investment, commercial, business, real estate. So that's what we're talking about. You've got a piece of property you're selling. I'm going to use a basic example here. Kind of a simplified example, but I think it helps explain it. So let's say you have a duplex, so that's an investment property. Let's say you paid $300,000 for it, now you're gonna sell it for $400,000. So you've got $100,000 of gain or profit, you can use that term if you like. Sometimes I like to use that term, it's just a little more intuitive for people to use that term profit. So that $100,000 is gonna be subject to tax. And what you're trying to do is defer that tax or avoid paying that tax. And section 1031 of the tax code says, if you exchange that property for another piece of property, another piece of investment or commercial property, then you can defer that tax. So that's essentially what we're talking about, is the ability to roll that gain into that new piece of property and not pay taxes. So any questions? What taxes are we talking about? Now, I'm not an accountant. Whenever we have a new customer, we typically like to do a little consultation with them, sometimes long if they've got a more complex type transaction, sometimes basic if they're just selling a duplex and buying another duplex on the other side of town. But we still like to go through a few of the basics. Part of that consultation invariably is myself saying, you got to check with your accountant or tax preparer, however you do, because it does affect everybody a little bit different. What capital gain taxes you're going to pay? There's a couple different capital gains tax rates, 15 or 20%. What bracket you fall into is dependent on the rest of your income, the rest of your earned income. And so that's why you got to look at your entire tax picture to determine where you're going to fall for capital gains taxes. Again, I like to give people some generalities. Typically, when you start to look at all the different taxes you're talking about. So capital gains tax in my example I just gave, that's that $100,000. That's what you're going to get taxed. And the top rate there is 20%. But you can also have to deal with depreciation. So let's say you've owned that duplex for, let's say 8 years or so. During those 8 years, you can take depreciation deductions on your taxes, which helps you save taxes during that time. Well, what happens when you take that depreciation is your basis will go down. So the starting basis was that $300,000. That's what you paid for the property, that's your starting basis. That basis number actually goes down as you take those depreciations. So let's just say a simple number again, let's say you get down to $250 for your new basis. So now when you sell for that $400,000, you've got capital gain of 100, but you've got depreciation recapture on 50 of that 400 is now depreciation recapture. And that's actually at 25% in most cases. So that's even a little higher, so you got to deal with that. At the federal level, you're also going to get the net investment income tax, that's 3.8%. That kicks in at a certain income level. So again, doesn't hit everybody, but can hit part of that gain if that affects you, and that's 3.8%. And then don't forget the state's going to ding you too. Now, Wisconsin starts with your ordinary income tax rate, gives you a 30% exclusion off of that. Again, depends what the rest of your income looks like, but you're going to have to deal with the state. When I throw out rules of thumb, maybe in a duplex example like that, I probably tell people when you try to balance that all out, yeah, probably 25 to 30%. If I'm working with somebody who's got a larger property, maybe a commercial property, a strip mall or something like that, all that starts to hit them, but they might be at higher rates on some of that. So it's probably over 30% that they're going to pay taxes. So it adds up quick. Yeah, even a small deal that you've only owned a property for a couple of years, if you've got some appreciation on it, it does add up. So that's why you do an exchange. All these taxes can be, avoid paying all those taxes with an exchange. Now, I do like to make sure people are aware how that works. So Deferred exchanges are just that. You're deferring the tax. You're rolling that gain. In my example, let's go back to my simple example, that $100,000. It's not tax-free. You're rolling that gain into the new property. So it's tax-free at the time you do that. But the IRS looks at it as a trade. You've just traded the old property for the new one. And that's really the policy behind that section of the tax code is you just continued your investment from the old property into the new. Just like two kids trading baseball cards. I had the old card, now I got the new card. It didn't cash out. And that's a big piece of the process we have today that some of you are probably familiar with, the whole don't touch the money part of that process. And so that's where you're simply taking that old gain, moving it into the new property, avoiding that tax, keeping that tax money working for you. And that's essentially what we're talking about, is an exchange of properties. Okay, questions on that at all? Yeah.
So that whole game, that whole amount, if I have a son and he'd like to take his profit and take a third and put it into investments, a third and rehab his kitchen in his primary, and third and put it into a new duplex, is he going to be taxed on those 2/3?
You will, yeah. Yep.
Sure.
I'm gonna jump ahead and then that'll get me to answer your question, which is probably the number one thing we talk about, is running those numbers. Okay, so I'll get to your question, but I'll give a little background first. Yeah, okay. So when somebody's doing an exchange, the way the IRS calculates an exchange is they expect you to do a full exchange. So if you're selling that duplex for 400, if you want to pay no tax, you have to buy another property or properties. You can buy more than one, but you got to buy another property at 400. Or more.
Between two.
It can. Yep, that works. Yep. So that's rule number one. Rule number two is you cannot touch the money coming out of that sale. So whatever the proceeds are, and the money coming out of the sale is really the equity in the property. You're selling it for 400, you pay off your mortgage, whatever that is, and that actual proceeds, the bottom line on that closing statement, goes into an exchange account. Again, I'll get into that a little bit more when we start to talk about the process. But it's key that the exchanger not touch any of that money from this. So let's just say that duplex you're selling for 400 and you got a mortgage for 200. So you got that mortgage gets paid off at the closing. You got 200 going into the exchange. You have to roll that whole 200 into the new property, but you still have to replace that mortgage on the new property, which means either cash out of your pocket or probably 90+% of the time a new mortgage on the new property. But it does mean that if you're selling for 400, you got to buy in order to pay no tax. Now you can have a partial exchange. So let's just say you buy for $390 without getting into closing costs that can come off the top. But simple example, sell for 400, roll all the cash through, but you still bought for $390. You're just going to get taxed on that $10,000. The rest of the gain will be tax deferred. So you can do a partial exchange that way. It's not all or nothing, but if you don't buy for 400, you're going to have to pay some tax. So in the example, you have, if that customer pulls out some cash and uses it to rehab his home or whatever, that's going to get taxed. It can work, but what I would want them to do is look at how much gain they have, and let's, how much roughly, pull out 100 instead maybe, or maybe you didn't give me. How much?
300,000.
Okay, all right. So whatever they pull out is going to be subject to tax. So it's considered coming out of that taxable gain piece of the sale. What I would have them do if they really want to do that is figure out how much total gain you have. So if they're pulling out, let's just say they're pulling out 100. Well, in my example, your whole gain was up. So then the exchange isn't going to do, because you're gonna get taxed on the 100. Well, that would have been your tax had you not done an exchange. So unfortunately, that in that case, if I'm talking to them, I'd say, you can still do the deal. You can still sell that property. You can still buy another property, but you don't need to engage us because in the end, you're going to pay the same amount of tax. Yeah. As I said, that's the number one thing we talk about with people. The reason is it's just not always that intuitive. People tend to think, okay, I got $100,000 of gain. That's all I got to roll over. All I got to do is buy something for 100 because that's my taxable piece of that sale. If I just did a straight sale in my example, again, you bought for 300, selling for 4, you got that 100 of profit. People think, oh, all I got to do is roll over that profit. All I got to do is buy something for 100. Unfortunately, that's not how it works. Or people tend to conflate a little bit that tax calculation with their equity. And that's what I mean by it's two different equations. The tax calculation is always going to be calculating what is your gain. What's the difference between your sale price and your basis in the profit? It has nothing to do with the mortgage. But people tend to think, okay, if I have a $200,000 mortgage, I sell for 400, I'm walking away with 200. All I got to do is roll over that cash. And that's absolutely not the case. Two different calculations. You might have no mortgage on that property. When you sell it, you're still going to pay tax. You're going to get 400,000, right? If you've got no mortgage when you sell it, but you're still going to pay tax on that 100,000. You might mortgage that thing to the hilt and have 2 or 3 mortgages. When you sell it, you're not going to walk away with a nickel. You're still going to have to pay tax on that $100,000 of gain. So it's 2 completely different calculations. And again, people tend to not intuitively follow how the IRS looks at an exchange. Again, they tend to think, I'm just going to pay tax on the money I actually put in my pocket, which makes sense. I understand that. But that's why I like to make sure people clear how it works with that. I hope that helped. Kind of makes sense. Okay. All right. Okay, so I'm going to go through a couple particulars here with Section 1031. So as I mentioned, first of all, it's for investment property. You might hear that term like kind, which is in the tax code, but it's almost irrelevant when it comes to like kind. People tend to think, I'm selling a duplex, the like kind says I have to buy a duplex. That is absolutely not the case. You can exchange any type of investment property or any other type of investment property. You could sell a duplex and buy a warehouse or a strip mall or even land works. It does not have to be the same type of property. That's a little bit of a misnomer or a myth. But it does have to be some kind of business or investment property. So what really doesn't work? Personal use property doesn't. So your home doesn't. Your lake home that you've never rented and is just for personal use strictly, that doesn't. It might be a good investment, but for purposes of an exchange, the IRS has said that's not an investment property for purposes of a 1031 exchange. So that doesn't work. What also doesn't work? Developers cannot do exchanges. The reason is because the tax code distinguishes between different types of property or assets when you're selling them. 1031 exchanges apply to capital assets, an investment property. If you bought stock, you pay capital gains tax on it. So it's capital gains tax versus ordinary income tax. So if you're in the business of buying and selling something for profit, like a shoe store, you're buying shoes, you sell them at a profit. You're holding that as inventory. You bought those shoes just to resell them and make a profit. You pay ordinary income tax on them. You didn't buy those shoes as an investment. You bought them to resell them. Same thing in real estate. If you're a developer, let's say a typical home developer buys up a big chunk of land, develops it into homes. They can't do an exchange because that's inventory. They pay ordinary income tax because they are in the business of buying and selling that property purely with the intent to resell it. So they can't do an exchange because it's a different type of tax. Now, somebody doing a flip gets caught up really, or can get caught up in that same terminology. If you're doing a pure flip, so you bought a property just to fix it up, just to resell it, that can be risky to have that be part of an exchange. Now, there is no set time period in any of the exchange rules how long you have to hold a property. So it's not as if you can cross over that 6-month period and all of a sudden you're okay. It's an intent-based question, meaning if you bought the property and your intent is just to resell it, that's why you acquired it, or the primary intent is to resell it, then you can get caught up in that same verbiage in the tax code that says that really you're in the business of buying and selling property, at least for that particular piece of property. So that's why being a flipper, you really can't do an exchange. I do have people that are quasi in that business, but if they want to be on the comfortable side of doing an exchange, they'll rent it out for a little while. You know, that's not what they want to do, but if they want to keep growing that investment, they'll hold it for a while, they'll put it up for rent. That shows some investment intent. It generates some revenue that they can report on their taxes, and then they are able to much more comfortably do an exchange. Yeah.
If you buy like property for personal use, let's say you rent it out for about 6.5 months of the year, can that be considered investment?
There are rules on that, yeah. I like to say there's two sides to that coin with the IRS rules. One is rental side, one is personal use. They're actually not very strict on the rental side. It doesn't have to be an apartment with a typical tenant year lease. You can do short-term leases. It can be vacant for a while. So on that side of the coin, sure, if you rented it for 6 months, it would satisfy that side of the coin. The tougher side, though, is the personal use side, and maybe that's not the example you're looking at, but typically the tougher question for people that I'm talking about or talking with is the personal use, and they only allow 14 days a year personal use. So anything more than that could kick you out of qualifying for an exchange. So that's the more strict piece, and that's the tougher piece. If you do have a lake cabin and you rent it out in the summer or a few weeks here or there, you're going to probably satisfy the rental side of it. But if you're there significant amount of personal use time, then that would put that into a pretty risky category. So that's the
We determine that. I
Yeah.
mean,
that's the question I always get. How are they going to know when we're there? Yeah. So that's a good question. Off the record, it is a good question. I suppose if you got audited and they wanted to go through your life with a fine-tooth comb, they might be able to figure out, you know, where you bought gas and where you bought groceries, and, you know, that kind of stuff. But that's the question I typically get. How are they? Now, what they really do look at, though, is just 2 years. So the context I'm often answering that question is if somebody's selling that duplex, let's say that example, but they do want to buy a lake home, or very common to buy something in Arizona or Florida. We get that a lot. What the IRS looks at is 2 years. So after 2 years, they don't care. So you're selling property here, you're going to buy a townhouse or something in Florida. As long as you keep it primarily as a rental for 24 months, 2 years, then you satisfy the exchange piece of it. After that, they don't care. So then if you want to have it more personal use, or even your plan eventually is to go live there, that's perfectly fine. That will not invalidate the exchange that you did, as long as you keep it that investment property for 2 years. What you can't do is buy it, say, yes, this is going to be an investment property, and then a week later, I kind of changed my mind. That's what doesn't stop. Yeah.
If you're a flipper and you decide to rent it out for a while, is there any number of months you have to rent it out before Okay, this scenario, we think that.
There is not any rules on that. I suppose if you got audited and then that came up, the only way it would really come up would be in the sense of, okay, you own this property for the last 6 months of the year, but you only showed rent for 1 month. You know, what was going on for the other 5? If you're fixing it up, I think that's very reasonable. If it needed to be fixed, I don't think you'd have an issue with that. If for some reason it was up for rent and just didn't rent and you lower in rents, that's reasonable. So as long as you're operating it as an investment property, I don't think you'd have an issue. Of course, it's the people who buy the lake property, they're only reporting a month of rent and they're claiming it, I didn't use it the other time. So what are you telling the IRS? Well, you're telling the IRS it just sat there for 5 months unused. That might be a risky sell. Yeah. And it's going to vary by type of property, right? If you live on one side of town and you're owning a duplex on the other side of town, pretty clearly that's an investment property. If you live on one side of town and we're talking about a lake property somewhere, that's going to be a tougher sell to claim that you were never there, the person. Yeah, so it's because there is no set time period that you can magically cross over. It's very case by case. Yeah, it's very, what did you do with the property? What's going on? Yeah. Okay. All right, so I'm just going to touch on this a little bit. I often get the question from people, well, should I do an exchange when should I do an exchange? And I tend to say, you want to seriously look at an exchange when you can answer yes to 2 questions. One is, well, run those tax numbers. Are you going to have some tax due on the sale? If you buy a duplex for $300 and you're selling it for $330 and your closing costs are $20, probably doesn't pay to do it because you don't have much gain at all. And maybe you put some repairs into it, which may have actually raised that basis a little bit. So you got to do that analysis. Do you have some gain? And often when I'm speaking with people to try to get to that question a little bit, I'll just say, hey, how long have you owned this? And if they say, well, I bought it 2 years ago, then I might dig a little deeper because they may or may not have much appreciation value. But if they said, oh, I've owned it 12 years, well, then I'd probably stop that analysis because they probably have some appreciation in there. So they're going to have some gain. And again, the longer you own it, the more appreciation you have, the more depreciation you've taken. So that's pretty easy way to get to that answer, at least as a rough answer. And then the other question is, can you find a suitable replacement property? And in some markets, like right now, depending on what you're looking for, that can be a little tough. I'll get into the timing to do an exchange, but I would never tell anybody to do an exchange to avoid the tax and then buy a replacement property just to avoid the tax. If you're just not comfortable with that new property that you're buying, that doesn't make sense. Don't avoid 30 grand in taxes and then overpay by 30 grand for a replacement property. So that's the second piece of the equation that I think always comes into play is when to do an exchange. You got to still want to buy other real estate, be comfortable with what you're getting. Okay, so let's talk about this a little bit. I'm not going to dive too deep into this, but it is a pretty regular topic. And again, when I'm doing a consultation with somebody, we ask this question just to get a little bit of feel for where they are with how they own the property. So the basic rule is the same taxpayer rule, right? If I'm selling that duplex, I'm reporting to the IRS that I'm doing an exchange. I need to buy the new property. Well, that seems basic. That seems obvious, but often the question can be a little more complicated. And usually the complications come in with LLCs. If you work with any investors, you're going to see that typically people do own properties in LLCs. The unique thing about an LLC is that LLCs are always something else. What I mean by that is LLCs are created at the state level. You file with the state, create the LLC. The IRS recognizes that they exist at the state level, but there is no such thing as an LLC tax. You can't go to the IRS and click on their website and say, I want to file an LLC tax return. There is no such thing. And that's what I mean by LLCs are always something else. Most LLCs are disregarded. So what that means is by something else, they really don't exist. If I personally own an LLC, I own that duplex, that rent shows up on my personal tax return on Schedule E. Yeah. That's what I mean by disregard. So that LLC, something else, it's just a sole proprietor LLC, if you want to use that term. That LLC really doesn't exist. In other words, myself and that LLC are one and the same for tax purposes. But that very same LLC could be something else. So let's say I brought in my brother and now he owns part of the LLC. Well, now we've created a partnership. So that LLC now is a separate taxpayer. It files its own tax return. Partnerships file their own tax return. In cases like that, when I'm talking with somebody, I will say, hey, you don't own any real estate for tax purposes. The LLC does, the partnership does, and you own half the LLC. But from a tax standpoint, the LLC owns that. In a case like that, the LLC, the partnership, is doing the exchange. So we're running it under the partnership name as the exchange.
And S corp be the same.
Correct, yep. In fact, LLCs can actually be S corps and C corps. That's pretty rare, but that can exist. Or if you file a corporation with the state, and then it is an S corp or C corp with the IRS, then yep, they file their own tax return. It's a separate taxpayer. That's the entity doing the exchange. Okay. Questions on that?
The rules different for individuals and spouses versus LLCs or S corp, C corp, or same thing?
I don't see real estate owned by S corps and C corps too often, unless it's a business that happened to be operating on that property. It's a manufacturing facility or something and they own it. Just because often it's hard to get in and out of a corporation with real estate. So I don't see people investing in real estate using S corps and C corps too often, on occasion, but that's somewhat rare. Very common to use LLCs, very common. Again, if there's more than one owner, then it's a partnership, assuming not husband and wife. So in Wisconsin, because we're a community property state, a husband and wife can own an LLC, and that LLC is still considered a disregarded LLC. Other states, not all, but many other states, that's a partnership when it's not a community property state, but Wisconsin being a community property state, husband and wife can still own that LLC, still disregarded. So that's actually pretty nice how that works. And that's pretty common too. We will often get cases where somebody will come to me and they'll say, I own property in an LLC with my brother. So it's a partnership. But guess what? We don't want to be partners. We're going to sell that duplex. I want to buy my own property on this side of town. He wants to buy his own property on the other side of town. There's a few nuances and strategies to look at there. Typically, what we would look at is what's called a drop and swap. So usually what will happen is before they sell that property, they will actually kick that property out of the LLC. So there's a quitclaim deed to myself and my brother. Now when it actually closes, when it actually sells to the buyer, now I'm a 50% owner of the real estate. So now I'm a partial owner of the real estate, so is my brother. When we close that, I can do what I want with my half, including an exchange or cash out. Brother can do the same. So that's a typical solution to that problem, which happens quite. Yeah.
Who's tracking that initial cost and that exit cost? Because I mean, the exchange is really based on purchase price and what you've invested into that property. But then when you quitclaim it, there's no dollar amount associated with the quitclaim. And then it's exiting into individuals.
Right. Yeah. So from a tax standpoint, and if I see that going on, again, I'm steering them towards their account because I don't know the whole history of what happened with that partnership. But most of the time, if it's a pretty simple partnership, and it just owns that property or maybe a couple other properties, you can usually do a distribution out of the partnership without that being a taxable event. In which, as opposed to a corporation, if you had an S corp and you were gonna, let's say you had two owners of an S corp and you were gonna deed that property out of the S corp, that's a taxable event. That's part of one of the problems with an S corp. If you own property in an S corp, you're kind of stuck in that S corp forever. You can't really get it out. You can do exchanges, but it's hard to get the property out without a taxable event. But with a partnership, you can just say, we're winding up the partnership, we're just distributing this asset, and that's typically not going to cause a tax consequence to do that deed, to wind up that partnership from that standpoint. Is that your question, kind of a taxable event or the cost to do the deed?
I guess in that case, I was just wondering, I mean, is it just on their accountant to know the initial price and then what the, to track that leaving
Right,
the
right.
partnership?
Yeah, so they're gonna get kind of a pass-through basis. If the basis is 300 and you just distribute that out to the partners, they each get their half now is gonna be a 150 cost basis for each one. But yeah, you would go back and look at past tax returns, see what basis you've been reporting on that partnership tax return with depreciation you've taken. And again, if it's pretty simple, two partners, you just sort of split everything when you kick it out of that partnership. But absolutely an account question to take a look at what that looks like. Okay. All right, so let's get into the process here a little bit more, which I'm sure is what most of you want to take a look at. Okay. Of course, most exchanges are not just a swap. Years ago, you could do that. You still can, actually. But that just rarely happens, right? I want your property, you want mine. We just trade deeds, so to speak, and that's an exchange. Report that on your taxes as an exchange. However, that's not too practical in most cases, right? How many people want to actually trade property with each other? So that's really where we come in. The IRS says you can use an intermediary. You can sell a property today to one person, a couple months later, buy a different property from somebody else, and can still consider that an exchange, a trade of that old property for the new one. So that's really what our role is as intermediary. We go through this process, we do the right paperwork. If that connects the two properties together, even though they're two separate transactions at two separate times, you can still consider that an exchange of those properties. So the process really doesn't change too much from what all of you are familiar with as a typical sale process for selling some property. In other words, if I'm selling that duplex, I'm still listing it for sale. I'm still accepting an offer from a buyer. It's still going to closing as it normally would. The only real difference is we come in, we do some paperwork, going to be a little bit of tweak of the closing statement. And then, as I mentioned before, the big piece is that those proceeds from that sale have to go into an exchange that we do help court. So that's the big piece of that process. When that relinquished property, so that old property closes, that's really when the exchange begins. So that's when we do have to have this all set up. At that point, two time periods start to run. So the first one is a 45-day identification period. And that's essentially the time that you have to identify what replacement property you're looking to buy. And in that handout I had, there was on the last page is some of these steps too. All right, so let's go through that. Yeah, that 45 days, it's right in the tax code, unfortunately. It's a strict time period. It sneaks up on you, absolutely. Sometimes that's the tough piece of making an exchange work. But what the tax code says is you've got that 45 days to identify what property you're gonna buy. An identification is just fill out a form we send you, get that back to us within the 45 days, and you've identified the property. So you have to find the property. Logistically, doing the identification is easy. Again, just fill out the form and send that back to us. Now, there are some limits on how many properties you can identify. And there's really two main rules. One goes off a number of properties, one goes off a dollar fee. So the number of properties is 3 properties. You can put down 3 properties on that form, any 3 properties, doesn't matter the value of them, just list the 3 properties and you've identified the property. Should you have property under contract? Nice if you can, not required. So again, as long as you let us, intermediary, know what property you've identified, you've satisfied that requirement. But it is important to actually do it, because when you report an exchange on your taxes, the form you report the exchange on says, when did you do the identification? You have to disclose when that got done. The other possibility, and most of our exchanges go under the 3 property rule, but a few of them use the 200% rule. So the 200% rule says that you can identify more than 3 properties, but then the limit uses a dollar amount, and it's 200% or twice the value of the property you sold. So going off my example, if you sold that duplex for 400, twice the value would be 800. You can identify as many properties as you want, but together they'd all have to have a value under $800,000. So you can imagine that's probably going to be a little tough. Sometimes we get that if somebody's selling a commercial property for $1.5 million, 200% would be $3 million. Depending on what they want to buy, they might be able to buy or identify 4, 5, 6 properties under the $3 million. So that happens from time to time. You don't need to do both. One or the other works. So either 3 properties or under the 200%. This is a little bit grayed out, that 95% rule. That works too. I don't know if I've ever had that actually come up. It's sort of a catch-all. If you screw up the other 2, you might be able to save your exchange with the 95% rule. It's not 100%, but it's 95%. And what that means is, if you screw up the other 2 rules, if you still buy everything you identified, then your exchange is still valid. But as you can imagine, nobody wants to rely on that because, well, what if one deal falls apart? It blows up the entire exchange. Now, it's not 100%, it's 95%. I guess the rule maker said we'll give you a 5% leeway. But either way, the way I read it, it has always been, if you buy everything you identified, your exchange still works, even if you blew the other 2 rules. So again, it's a bit of a catch-all. If you screwed up, then maybe you can still make the exchange work, but nobody's going to want to rely on that other rule. So that's why I kind of have it read out. It just okay. So what if you fail to identify a property? Your exchange is dead. As of day 46, the funds in the exchange account go back to you. Your sale is just a taxable sale, as if there was no exchange. There's no penalties. You get all your money back, but your exchange unfortunately didn't work out if you failed to identify. All right, questions on that at all? Okay, and then the other time period is 180 days, about 6 months. That's the time that you have to actually close on the new property. Both the 45 and the 180 starts when you close your old properties. So you got 45 plus 135 to close on the new property. If you close a deal late in the year, you might need to file an extension on your tax return to get the whole 180. But absent that, you have 180 days to close on the placement. That closing, again, going to occur like it pretty typically would, putting in an offer, getting accepted offer, doing closing with the title company. Funds now are coming out of the exchange account in order to fund that sale. Probably some loan financing coming into that closing too. So again, doing an exchange really doesn't mess with those closings too much, other than some paperwork and how those funds flow to make sure you can report it as an exchange. Yeah.
So the exchange is there, but somehow it falls apart. Now, what? Now you pay taxes on,
Yep. So you're just gonna pay tax on that duplex that you sold as if there was no exchange. Yep. For whatever reason, either you couldn't identify or you identified and that deal fell apart. Again, there's no penalties. All the money in the exchange account will go back to the exchanger, but unfortunately their exchange didn't work. So it's just as if that exchange never existed. Their duplex sales just gonna be a tax.
but when this money is in the exchange account, who's earning the interest on it?
It does earn some interest, yep, or can. It's pretty minimal because they're very short-term accounts. Maximum the accounts can be there at 6 months. Our average is half that probably. So it can earn some interest, but it's below what a typical money market would be just because the bank's not going to be
The money markets are all over the place, depending on who you're talking.
correct. Yeah. So it's pretty low, but it kind of. All right. I think that's gonna wrap it up for me. I'm gonna just, since we got a couple minutes, I'm just gonna hit on a couple other items. Reverse exchange, doing quite a few of those lately. I'll give you the overview of what that is, just in case you're curious. But there's also ability to do some new construction with an exchange. Seller financing is something we can talk about, the pros and cons. And then if you're buying from a related party too, there's some rules with that. But reverse exchange. So reverse exchange is a process that the IRS has laid out where you're trying to buy first instead of sell first. And in some markets and some types of properties that works out well, but it's quite a different process and more costly too. The reason is because from the exchanger's point of view, they still have to do a sale and a purchase in that order based on closing. So not contract dates, but based on closing. That's always. So if you're trying to buy first, how does that work? Well, the procedure the IRS has laid out said you can have an exchange company come in and actually hold that new property for you. We have a holding company that facilitates reverse exchanges. What happens is the title to that new property actually goes into our holding company initially. And we call it a park file. We can park it for up to 180 days. Which then gives you, the exchanger, the ability to market, sell, close that duplex, acquire the property we are holding, and you still did an exchange in the correct order. I also like to say you can't own both properties at the same time. So that's why we hold title to that new property for you for a period of time. And then of course, again, that allows you to do the exchange in the right order. The final transfer, we call it, will be after you've sold that duplex and closed on it. Then we transfer that park property over to you. Again, that way you did the exchange in the correct order.
But you purchased that new property.
But that new property then is, the seller on that deal is ready to close. And again, your other deal's not ready to close yet. So the title goes into our name. Financing is of course a question. We don't finance it. It's still something you come up with either through your lender or sometimes we'll get cash reverses. So that's always one of the big hurdles. But title would go into our name.
The title is in a new buyer's name initially, because they're purchasing this new property, but you're holding the title.
Title is actually in our holding company. Yep. So the deed goes to our holding.
So the buyer dies. Now you guys title to it. So now what?
You mean if something happens to the exchanger?
Yeah, same thing.
Yeah. Well, either way, if they complete the exchange, meaning they sell that duplex and then we transfer that new property over to them, or we don't have this happen too often, but years ago we did more, where that old property never sold in the 180 days. So then we're still going to transfer that new property over to them. And in that case, they didn't do an exchange, something happened to that exchanger, then it would just go to their estate. So we're still gonna transfer that property to them when we get to that 180-day point, whether they completed the exchange or not. Because again, we're just holding it for them, temporarily to make the exchange work, and if it doesn't, then unfortunately it doesn't. They wouldn't pay any tax if they didn't sell that old duplex, because they didn't sell it, but now they're gonna own them both.
Oh, the goal will get financing or something like that.
That's a good question, yeah. If you can do a cash deal, it makes it a lot easier. I'd say this year so far, almost half our reverses have been cash deals, so that's so much nicer. If it's a smaller investment property where you're trying to get a quote unquote conventional loan, probably. Most reverses with financing are commercial properties, you know your banker, probably a smaller bank or credit union, where they can really go through what's happening. They're comfortable with you proving your credit. They can still put a mortgage on their property, so they should be able to check all their boxes. But some just can't quite get comfortable with it. Doesn't fit their menu of loans, and they just can't make it work. If somebody says to me, hey, I'm doing this financing through Wells Fargo on a reverse, I just say, yeah, probably not. You know, nothing wrong with Wells Fargo, but some bigger lender, again, they've got their menu. Here's the loans we give. You got to check all their boxes. If we have to think about it, it's probably, and that's just what I see. So that's the number one hurdle with a reverse is, yeah, title's going into our holding company. So if you're going to your bank and saying, I want to buy this property, but oh, guess what? For 3 months, I'm not going to own it. Well, again, they can still get their mortgage. They can still get a personal guarantee from you. So if you have somebody who's a banker that can work through it and approve all those pieces of it, it can work, but sometimes it doesn't. Yeah.
So does the deed go into the intermediary's name as well?
It does, yep. Actually, what we do is set up a new LLC to hold title. So the deed buyer, the transferee, or grantee on the deed will be that new LLC owned by our holding company.
And the timeframes are the same, 45 and 180?
We still have 180
to be sold, and then closing on that property.
You still have 180 to wrap it all up, correct? Yep. When we do that final transfer, so what that means is you've now sold and closed the old property, you're ready to really do the exchange, acquire that new property from us. Most of the time, we will just have you become the owner of the LLC. So title to that new property went into an LLC owned by our holding company. When we're ready to transfer it to you, instead of a deed, we will actually transfer ownership of that LLC to you. Because it's a disregarded LLC, it doesn't exist for tax purposes. When you become the owner of that LLC, you bought that asset for tax purposes. You own that asset. So that's just a nice, clean way to transfer that property. If you are working with a lender and they've already mortgaged, they can use that LLC as the borrower, mortgagor on the property, and that just runs forward after you become the owner of the LLC.
And how would you handle an income producing property in that case?
It's still your rent. You still collect that rent. Part of the paperwork we do is a possession agreement. It works kind of like a master lease, if you will. So we are on the title, but of course that's still your rent. So you become the possessor of the property, and you're still collecting rent from tenants, commercial, residential, whatever. So we have nothing to do with that. That still all goes. Yeah.
In either the listing agreement or the offer of purchase, is there a specific language you recommend that as an agent we put in to identify the intent?
I do suggest it. It's not actually required. There's no magic language. If you want, send me an email and I'll send you some suggested language we have. The only real requirement is that the other party does get notice that you're doing an exchange. And that's in all our paperwork, and that can be done right up to closing. So we always have that in all our paperwork to make sure that gets done. If you put that in the contract, great, and then they've got their notice and it's covered, a little bit of a backup. But there is no actual rules from the IRS that that contract has to have 1031 language in it. If you're working on a contract and you're asking me, should I put that in there? I'm gonna say, yeah, I suggest it. Couple sentences, again, there's no particular magic language, but I suggest doing it. If somebody contacts me and says, we've already got this contract all signed, I'll say, and don't go back and do amendments now, because it's really not.
So the buyer's not required to sign off on it?
The buyer doesn't need to get notice of the exchange. So in the paperwork we do, they will get that notice and we ask them to sign that they've acknowledged they've received notice of the
So it
exchange.
would be better to have buyer agrees to participate in the exchange, because otherwise if they say no.
Well, they really can't stop the exchange. If the buyer doesn't want to sign that, then we just make a record in our notes that they were given notice and they refused to sign. But that's why, yeah, certainly nice to put it in the contract right up front. They know what's going on. They can ask their agent questions or ask anyone else, hey, what is this? So it's not a surprise at closing. That's why I suggest putting it in there. You know, if you can, do it right up front, then it's covered.
There's really no risk to the seller if someone is purchasing the property. So, I mean, disclosures are great. There's no damage.
Other party doesn't care.
Right.
No, it doesn't affect them at all. All right. Yeah.
So what are the fees or costs then associated with doing the 1031?
Yeah. Yeah, so most of our transactions are just a $750 flat fee, assuming one sale property, one replacement property. Extra fees if there's extra closings. So let's say you're selling that duplex and you're buying 2 duplexes. So there's an extra fee for those extra closings, not on the first one, because we just do that one $750 for the whole thing. But if you buy extra properties, then there could be some extra fees there. Reverse exchange is priced about $5 to $6 grand to do a reverse, because our holding company comes into the picture. So we have to do more tax reporting, more accounting, all that good stuff through our holding company. As you can imagine, we have got a deeper involvement because we actually own that property. So that's why those are pricey.
So that 750 is taken on that first closing when you're gonna take the funds.
We just have it be part of the closing costs on that closing statement, yeah. So it's just part of those costs. All right, Candace.
Have you seen very many 1031 exchanges being used in large commercial transactions?
Oh, absolutely, yeah. This year we've done some multi-million-dollar land deals, hotels, office buildings, anything commercial works. That market's been dynamic because the interest rates have hit that market a little bit more. Demand for some of the smaller residential investment properties has kept up. So I was fearful interest rates would really hurt our numbers, but they haven't been too bad as far as that piece of it goes, just because, as some of you probably know, that demand is kept pretty decent. But yeah, we've seen some changes in the larger commercial transaction, just not quite the volume, and different segments, as you know, and that's just always throughout history, different commercial segments are hot and other ones go off, just depending on what supply and demand is out there. But yeah, we do exchanges of all sorts of business and commercial property. All right. Yeah, one more question. Yeah.
So what kind of paperwork or documents really go with the transaction? Sounds like you need to keep these for on level, like the timeline and like with filing your taxes. So is there certain documents that are used for the tracking, or is it something that you really just rely on your, to figure out?
Yeah, so when you're doing a typical exchange, there is a package of exchange documents that we put together that the exchanger signs. None of that goes to the IRS, and but you just want to keep it in your file, of course. Same thing with the identification form, so you have to report that on your tax return. When you report an exchange, it's Form 8824, that's the form you use. You add that to your 1040, and that reports the exchange. So that's where you report what I sold, how much I sold it for, what my basis was, my gain, how much gain I rolled over, what I bought. So as any tax form, you go through all those numbers and you get to the bottom line as to whether you have some tax on it or you had a fully deferred exchange. But the rest of that paperwork doesn't go to the IRS, just something you would keep in your file. Even the ID form, you just keep it in your file. Make sure if you did get audited, you want to be able to prove you did all that, but none of that goes to the IRS. We don't report anything to the IRS at all. It's strictly you do the exchange, you report it on your tax return that you did it, and again, assuming you don't get audited, that's all that gets reported. The title company is still going to do a 1099 on that duplex sale because they're required to. And so that's telling the IRS you sold that property for $400,000. So the IRS now knows you did a sale. So they're going to be looking on your tax return for you to report that sale. So either it was a taxable sale, or they're going to see if you did an exchange, they're going to match that up and say, okay, well, they did that sale, but they didn't report any taxes because they reported the exchange. And then that matches up with that 1099 that they got from the title closer.
Are there many exchanges going on right now? Because shouldn't call name 3 properties.
We've kept pretty busy, but I hear that a lot. People say I can sell like that, again, depending on what they're selling, but I can sell like that. Can I find a replacement property? That's the tougher part. Yeah. So that's done a couple of things. One is it's increased how many reverse exchanges we're doing. Again, those are pricey, but people say, well, if I can find the exact property I want, I can have Patrick's office come in and close that next month. And then I've got 6 months to sell what I want to sell, and I'm comfortable that I can do that in 6 months. Yeah. So more reverses. We do get people that will set up exchanges. They don't have a replacement property figured out, but they'll set up the exchange. They'll pay our fee, and they'll say, hey, I just bought 45-day option to find something. And if I don't, I get my money back. Again, like you said, no penalty, nothing lost other than our fee. They're out our fee, but they'll say, hey, I'll pay that for 45-day option to try to find something. So a lot of people will do that. They don't have anything figured out, but they'll say, if they do a lot of deals and they're usually comfortable that something in the pipeline can come along, they'll do that. But they might know right offhand, hey, my 45 days might expire and my exchange just dies, but they're okay buying that fee or using that fee to buy that time period option to do it. All right. All right, well, thank you so much. I think Candace has a door prize.
Me too. I was watching Katie, so she did not put any of her cards in. She was tempted to. But thank you so much, Patrick, for coming today and doing our presentation. We will probably have another one as well. We're going to do a commercial one, but we're going to invite other residential realtors to attend as well. The last one we did, I think, was last week, Friday, where we had a client that all of a sudden was selling the property, and at a fourth afterthought goes, oh, maybe I should do a 1031 exchange. So by Tuesday morning, we had reached out to Patrick and we were able to close on Friday in doing that starter. We don't like to have a rush like that all the time, but I mean, if for some reason, if you do have a client that last minute decides that yes, they want to do the exchange, they can get it set up. We've done quite a few of them at Landtrust title. We do them all the time. We do them here in Wisconsin, Illinois. So we're well versed. We know who to reach out to. We know what questions you're going to be asking. But if you can deal with an attorney that does a really good job, knows his craft, and that's what he does 24 hours a day, and very reasonable, you can reach out to some other individuals which are not as reasonable, and we know that. So I'm always watching that for our clients as well. So thank you for coming. We are going to now go for it. Winning person, winning chart.